coronavirus pandemic has brought much economic activity around the world to a halt, making a global recession inevitable. But it could become a depression if policymakers don't act fast enough. In this edition of the debate, we will look at the depth of this pandemic and whether countries across the world, in particular the U.S. and European countries, will be able to win this battle against this deadly disease.
U.S. stocks have struggled to rebound from their steep losses on Monday, when Wall Street recorded its biggest tumble since the crash of 1987. The slump in Wall Street stocks came as the New York Federal Reserve announced for the second consecutive day a $500 billion cash injection into banks. It was the latest in a series of debt purchases and cash infusions to stem the economic fallout from the COVID-19 pandemic and prevent financial markets from seizing up. Earlier, the ratings agency S&P Global warned that the coronavirus pandemic will cause a global recession this year. S&P cited a cash flow slump, much tighter financial conditions, and oil price shock as reasons behind a possible recession. The agency also warned that the COVID-19 outbreak will increase U.S. corporate default rates to over 10% in the next 12 months. It said European countries will also see a corporate default rates spike. U.S. President Donald Trump has also expressed concern over a likely recession for the American economy.
The stock market took another hit today. Is the U.S. economy heading into a recession?
Well, it may be. We're not thinking in terms of recession. We're thinking in terms of the virus. Once we stop, I think there's a tremendous pent-up demand, both in terms of the stock market and in terms of the economy. And once this goes away, once it goes through and we're done with it, I think you're going to see a tremendous surge.
Market analysts say governments need a, quote, fiscal bazooka to help businesses survive the COVID-19 pandemic.
So mortgage holidays, payment holidays, that sort of thing, forbearance for companies who are in difficulty due to cash flow problems. If we see a big enough fiscal bazooka, then we could well see a bottom in markets. But at the moment, markets will remain volatile in the absence of concrete action by politicians.
Governments in the U.S. and Europe have taken measures such as shutting restaurants and schools, as well as asking people to stay home to contain the pandemic. However, investors are concerned the crisis could snowball into something bigger than a recession, including a credit crisis or even a depression.
Our guest joining us in this edition of the debate, Professor of Economics at Metropolitan Autonomous University, David Barkin, joins us from Mexico City. We have economist and commentator Marco Pietropoli, who joins us from LIGURIA, Italy. I'd like to welcome you both. Marco Pietropoli, let me first start with you and Europe. The European Union will go through a recession this year due to the impact on its economy of the coronavirus health crisis. Now, this has come straight from the European Commission. It's not as if the EU countries in particular were doing well to begin with. How much of an impact will this coronavirus have on Europe's economy, and do you agree with this? Okay, let me address this to you, if I may, David Barkin. Looking at Europe first, the European Commission coming out and saying that Europe is going to be experiencing a recession. How severe, if you agree, how severe a recession do you think this will be, based on what you're looking at?
I think that we're looking at a very severe recession because unlike what happened in 1907, 1908, what's happening right now is not just a financial reaction in the financial markets, but it's actually removing people from the workplace and removing people from daily life and the kinds of activities which they're involved in. So that what we're going to have is not only a financial problem, but we're going to have a real problem which is going to affect directly the nature and the volume of economic activities that are going on in the world.
Okay, when you talk about this having a effect on the global economy, that has also been analyzed, especially by the IMF, that the global economy will be going through a recession. So when you talk about the global economy going through recession, what does that exactly entail? Does it mean that Europe as a whole is going to experience it, hence by default it'll be the world economy, or are we talking about a number of countries that should get added to that, like the U.S.?
No, yes, I think it's going to be not only Europe, but I think we're talking about literally every country in the world. I think that it would be foolish in this moment to even think that any country will be left out of this process. The spread of the virus and the spread of reactions by local governments all over the world is to put people in self-administered isolation. And that means that productive activity in plants all over the world are going to be stopped. I mean, we're seeing that here in Mexico, in Peru, people are being stranded. Industrial enterprises are stopping their production lines. All sorts of repercussions of this in terms of the physical economy are changing, are slowing down, and as a result, what you're going to get is not only the financial, which is what is making the headlines now, the financial troubles, but you're going to have an absolute decline in physical production, and that means that you're going to have unlike what's happened in recent times, it's not only financial repercussions, but the change in people's ability to actually engage in production.
Interesting. Let me bring in Marco Pietropoli now to get his thoughts on this. Marco Pietropoli, you are in Italy. So some of the indications coming through not only just on Italy but as a whole for Europe are pretty stark. For example, the sales, tourism, service, etc. May fall by 50% if it hasn't already. Just one example. Of course, looking at how sealing off the borders to foreigners in a drastic bid to curb the spread of this disease is another, which has happened already, where EU has closed its borders. Tell us the severity of how this has impacted the economy so far and how far this will go in terms of its overall impact.
Well, we don't really know how bad it's going to get. At present, I've been in, myself and my family have been in complete quarantine for a week now, where no one is allowed out of the house except for medical reasons, or businesses, which only the essential businesses have been kept open, or for food shopping. Therefore, the streets are deserted, and hopefully we'll see some visibility in the next few weeks that these measures will start to bite, and hopefully we'll see a peak in cases, and then we will be able to start talking about relaxing the quarantine situation over the coming couple of months. We don't know how long this will take to actually control the virus. The impact on the economy, not only in Italy but around the world, is yet to be seen. My gut feeling is that even though restrictions might be lifted over the coming months in certain areas like Italy that has adopted quite draconian quarantine measures, that people won't necessarily immediately go back to the same kind of behavior. And certainly, as you've mentioned, countries like Italy that rely in large part on tourism. In 2018, Italy had 63 million foreign tourists, but there's also a huge amount of internal tourism, with Italians coming from the big cities to the seaside and to the mountains. This will reduce substantially, and we won't know really until a few months' time the total impact of this, but it is going to be extremely significant. As your other commentator was suggesting, is production levels are going to go down, but basically all type of human behavior, human economic interaction is based on people meeting and people working together, or people socializing in terms of going to bars, restaurants, and that is very much the European culture. So in the near term, there needs to be the visibility of when this virus is got under control and peaked, and then we will have to deal with the impact on the real economy, and of course the financial impact of all of this, in that it is unlikely whether the number of businesses will, all businesses will survive. Of course not. There'll have to be a certain number of businesses that close down because of a reduction in economic activities. That will then result in higher unemployment, and any business and any person that loses their jobs won't be able to service their debts. Therefore, we'll then start to talk about the financial impacts for the banks. The governments are going to then want to rescue as much of the economy as possible. We'll then have to discuss the sovereign debt problems, especially in countries like Italy, Spain, Portugal,
right,
Greece, where there's a huge amount of debt, but also it's the countries that rely the most on tourism as well.
Okay, let's look at the country that has the most GDP, and that would be the United States. So looking at the U.S., of course, the figures are very stark. Again, I'd like to forge some into one question for you, David Barkin. The U.S. President Trump, finally, he has said that the economy may be heading into a recession in the U.S. And when asked about jobs, he said the U.S. could lose, well, he didn't say that. He said it may go into a recession. Latest data, one of them for the U.S., that it could lose up to 1 million jobs in March because of this, the disruptions that are happening. You also have at the other end of the spectrum, the Fed and what it has done. Looking at interest rates, 0.25%, and also overall we're looking at a $1.5 trillion stimulus, $850 billion to be pushed through. But yet you have the stock market that's not showing that revitalization that you would think that it should. How bad is it for the U.S. at this point?
I think that it's very, very bad. I think that the problem is not only that you have the virus, but that you have still in the United States an inadequate public health service, which is not even gauging the magnitude of the infection, of the problem of the spread of the infection. And in addition to that, what you have is a closing down of not only industrial enterprises, but you also have the dramatic decline in that's already visible in New York, it's visible in San Francisco, it's visible in Seattle, where people are just simply refraining from their normal kinds of socializing activities. And that is going to impact the service economy rather dramatically and rather rapidly. If you add to that the fact that the United States doesn't have any real effective system for sick leave, for the economic impacts of this, and it doesn't have even an appropriate system for child care, you're talking about a completely different kind of social and economic impact than the kind that Marco is talking about in Italy. You're talking about a much more profound unraveling of the social fabric.
Well, Marco Pietropoli, what's very confusing over here, in a sense, is and very shocking, in a sense, is what the S&P has said, S&P Global. They made an announcement saying that the coronavirus will lead into the world economy into a recession. That we know, but it says it's going to likely result in a surge of defaults, and it cited the U.S. That. According to how they worded it, default rate on non-financial corporations in the U.S. may rise above 10% and into the high single digits in Europe over the next 12 months. break that down for us of how bad that sounds, because that sounds pretty high.
Well, the predictions are simply predictions. We know that there is going to be a significant decline in business activity, that whichever way you turn it will uncover the fact that the Western economies that we know and respect in some way is actually built on a huge amount of debt. And this debt will be uncovered as economic activity declines, and the defaults on the debts will then impact directly on the financial institutions and, of course, on the sovereign states, because the sovereigns will have to try and stop the financial system from collapsing, and therefore that'll impact on the sovereign debt. There is a staggering amount of debt, and really the virus is more, when it comes to the markets, is more of a catalyst to pop what has been an absolute huge bubble in the US stock market, principally pushed up by extremely low interest rates and a huge amount of money printing. But the Fed, we have to get to the point where we understand the Fed isn't the all-powerful institution that can create work simply by printing money. And we have to get to that point where we understand that the Fed won't be able to give work to everybody. And the more money that you put into the system is not necessarily going to encourage people to go and risk their lives and go out and spend money, when staying at home actually seems a pretty good option if it's risky to go outside.
Okay, and that's where the confusion, at least to me, comes in. And I'd like to ask you, David Barkin, because when you have the Fed making an announcement of $1.5 trillion, $850 billion that's going to be passed through, you have also the IMF that's going to come out. It has announced about $1 trillion. It's going to take it case by case by country, and most likely the ECB, maybe. But we know that individual countries in Europe each have a certain amount of money allocated for rescue or bailout or whatever you'd like to call it. But as our guest Marco Pietropoli said, no matter how much money you're going to put in there, people are not going to risk themselves. For example, you have the U.S., $50 billion for the aviation industry that they want to help out. How is that going to help the aviation industry when people are not going to travel and risk their lives? I mean, that's where the confusion comes in. Plus, they have loans that they have to pay, and then on top of that, they're going to accrue more of a debt when they don't know where the future is going to go?
I think you're completely right, but I don't think that your word about confusion is appropriate. I think that there's a great deal of uncovering of the global credit bubble. Marco used that term, and I think that it's very, very important that we understand that all of these measures are in the financial economy, but people all over the world are stopping to travel. They're going to take refuge in their own homes, in their own communities, and to the extent that this happens, this means that the basis of demand, which is driving each one of these industries, is going to drop. If you have a fall in the demand, and you also have a fall in the confidence that we're going to be able to pick up on this relatively quickly, then you're going to have a chain reaction that is going to go from first the financial centers to the industrial centers, and then it's going to go down to the small communities around the world that are interlinked into a process, a global supply chain. The really interesting thing about what's happening right now in many parts of rural Canada is how communities, and perhaps in the United States, although we don't have as much news about that, is that communities are beginning to hunker down and look for their strength and their ability to supply their own needs from within rather than going through the global supply chains. Mm-hmm. This is also evident in Mexico, and the news that I got this morning in Peru is that outside of Lima, outside of the 3 or 4 largest communities in Peru, the communities are also closing off to outsiders and are rediscovering their ability to to supply and to assure their own quality of life.
Okay, we got less than a minute. If you can answer this, Marco Pietropoli, I'm going to try to ask you something that kind of goes into this analytical type atmosphere, looking from way above into this whole system, the system that was created based on capitalism. When you have banks that are throwing money out there and they want these companies to soak it up. Do you think that's maybe where the problem is? Of course, they're more than happy perhaps to do that because they know that debt is good because they're going to get paid back. Hopefully, at least that's what I'm thinking they're hoping for. But don't you think that's where part of the problem is?
Part of the biggest problem is the staggering amount of debt that has been built up, not only at corporate level, but on a sovereign level. And there isn't the money to rescue all the companies and all the workers who are going to be out of work. So much more money printing will have to happen. There is no other solution. And debt is good in terms of spurring new investment and new production. But when debt is misallocated effectively by companies borrowing to buy back their own shares to keep propping up the stock market in that way, then there is a certain misallocation of capital, and that will all be uncovered as the debt bubble will be discovered, and it will have huge impact on the global economy once this debt is seen.
Thank you very much for that. Professor of Economics at Metropolitan Autonomous University, David Barkin from Mexico City, spoke to us. And you were just listening to Marco Pietropoli, economist and commentator from Liguria, Italy. Thanks for tuning in to another edition of The Debate from Mika Betahwe. Until next time, it's goodbye.